So you writing here, the worst is yet to come. What does the worst look like?
Well, we just released our projections for this year and next this morning. And what we are seeing now in our baseline is that growth for 2022 will remain at about 3.2%, but global growth next year will slow down to 2.7%. That's a 0.2 percentage point cut from our July forecast. So now 2.7% is a fairly low number, if you want. But to give a little bit of context here, if you open the hood, what we see is that about a third of the global economy is going to be experiencing a contraction this year or next. That means 2 quarters of negative growth. And so there's going to be quite a bit of slowdown in a number of countries already this year and going into next year.
And you also point out in your report along those lines that inflation is expected to cool in 2023 and 2024. Yet we continue to hear from Fed officials who say they're going to hike rates and they're going to keep them tight. They're going to keep them restrictive throughout next year. Pierre-Olivier, how acute is that risk of overdoing it, of over-tightening it at the Fed?
Yeah, so first, inflation is expected to come down, but it's coming down from a very elevated levels. I mean, we're projecting global inflation to be around 8.8% and coming down to 6.5 next year. And so this is only going to be happening gradually. And importantly, this is also under our baseline assumptions are assuming what central banks have already announced they're going to be doing, not just this year, but also next year. Now, there are 2 risks here that central banks are facing. One is that they could be doing too much, as you point out, and that maybe, by the time we get to 2023, the economy might be experiencing a stronger recession. There is another risk, and the other risk is that they are doing too little, because let's remember that inflation has repeatedly surprised us on the upside. We've had more inflation than we expected many, many times. Inflation has proved much more persistent and broader. So I think the idea that we might be doing too much is a little bit premature. We might actually, by easing too early, end up in a situation where inflation is brought under control, and then down the line, we have a much harder job to do to bring down inflation.
Pierre-Olivier, it's Alix in New York. It's great to get your perspective. What's the risk of financial instability led by central bank tightening?
Yeah, so we've seen pockets of instability in the last few weeks, in particular in the context of the UK. So the way to think about this is that financial markets have gotten used to very low interest rates, and that central banks are now tightening. We're moving into this monetary normalization and tightening. We're moving into an era where nominal rates and real rates are going to be much higher. So there is some adaptation, some changes are happening, and that can reveal pockets of instability in market segments. And central banks have a job also to ensure financial stability. They need to make sure that the system doesn't break. So here, it will be a problem if you only have one instrument. If you only have one instrument, and at the same time you want to tighten monetary policy and you want to guarantee financial stability, you wouldn't be able to do that. But central banks have more than one instrument. They can address pockets of instability with different tools. So, for instance, the Bank of England has announced that it has now a standing facility to provide financing against gilts. It can also intervene directly in the markets, like it did starting about 10 days ago. So there are various ways in which central banks can help make sure that we don't have too much market dysfunction and at the same time try to stay on that monetary tightening course. It's a difficult balancing act.
Yes.
So certainly their job is not easy at this point.
So Kwasi Kwarteng, the Chancellor of the Exchequer, is going to be going to the IMF meetings and has to kind of prove the fiscal discipline. The IMF made the unusual step of speaking out against the mini fiscal budget that Kwarteng announced. And I'm wondering, A, what are you going to say to him? And B, what are you going to say to Andrew Bailey, who's trying to do all the things that you just spoke about, including at some point selling their holdings in the gilt market and raising rates again? I don't see how all those things will fit together.
So first, I mean, and it's not just for the UK, but what we've been saying to all countries around the world is as they are trying to deal with the energy crisis, which is causing a lot of pain. I mean, households are facing very elevated energy bills, food prices are going up. It's not just advanced economies, it's around the world. We're saying, look, make sure that you don't implement fiscal policy that is going to be at cross purpose with what the central banks are trying to do. Because if you try to do this, it's like trying to drive a car with two drivers, each of them a steering wheel. It's not going to work. So you want to make sure that you don't create nervousness in the market and that you have a fiscal plan that doesn't aggravate the inflation pressures. And in a sense, that was our message conveyed to the UK authorities back then. And we very much welcome the announcement that there will be a fiscal event at the end of this month, that there will be an assessment by OBR of the fiscal plans in the UK. We interpret this as a sign that, yes, this is going to be done in coordination with what central banks are trying, the Bank of England is trying to implement. Now, to what the Bank of England has been doing, in a sense, it's been doing its job. It's been trying to maintain price stability, as it should under its mandate as an independent central bank, and at the same time address financial stability issues with these other instruments. So we're saying they're trying to address this localized market dysfunctions, and at the same time fiscal policy is sort of moving in a direction that is more consistent with what the Bank of England needs to do.
How much does it need to move from where it currently is, though? We had them back off of the 45% tax bracket of scrapping that. They're no longer doing that. But we do have the Institute for Fiscal Studies saying that Kwarteng needs to find £60 billion in savings to shore up confidence, which, of course, means slashing public spending. Would that be enough to give you comfort, or do you need to see a full U-turn of current policy from this UK government?
Well, look, it's too early to say because we haven't seen the details of what's going to be in the UK plan. I think they will announce that later this month. I think the general point here from our perspective is, of course, there is a need to provide assistance to households and businesses confronted with the energy crisis. It should be done with targeted temporary measures that don't work at cross purpose with monetary policy. There are various ways this can be implemented, and we don't have specific recommendations at this stage on that part. But the overall architecture of these fiscal programs need to sort of follow some of these principles. And I think within that space, we very much look forward to what the UK government is going to announce.